Hey, welcome to a topic we all need to know about, but don't want to. What is it? It's taxation. It's all about dollars, dollars, dollars. Okay, how much you earn and how much you have to contribute to the running of the country. Okay, and there's calculations to be done. You can do it with computers or calculators, and there's forms to look at and fill in, or you can do it electronically on your computer and submit it to the Australian Taxation Office that way. So we're going to look at all these things, and everybody who earns any money at all has to put in an income tax return in Australia. So let's have a look at how we calculate all these things now. It's exciting stuff, and let's have a look at the general idea of taxation. And the idea of taxation is it's your contribution to the running of the country. Contribution to running the country. So everybody earning any income needs to do this. And we'll look at the sort of scales and so on that are involved in our system in Australia. So, the system for collecting income tax from wage and salary earners is called pay-as-you-go. P-A-Y-G. Why? Because the government is not prepared to wait until the end of the financial year and give you a bill. You might not have any money left. So they take it out before you get your money. So employers deduct this tax from their employees' pay each fortnight or whenever you get paid, and then they pay it to the Australian Taxation Office at the end of the month. And they must do that. Then at the end of the tax year, which is 30th of June, usually called the financial year, you get a chance to see if too much tax has been taken out or not enough. So the employer gives each employee a certificate showing the total amount earned and the tax has been deducted. This is called a group certificate. 2 copies. You keep one and send the other one in with your income tax return if you're doing hard copy, or you put the details of it on the e-tax form on the computer. Okay, so these certificates are needed by salary earners and wage earners to prepare your tax return. And we're going to look at all those aspects. In this presentation, we're going to look at how you find out your taxable income, some of the deductions, the rebates, and then in the next presentation, we're going to look at how to put it all together to complete a taxation return. All right, come on down and have a look. Here's the tax return. Eventually, we will get to this. Each wage and salary earner in Australia has to prepare a tax return. Covers the whole year. The return shows the total income earned and the expenses incurred in earning that income, called deductions. You are allowed to take off money spent that you needed to get your money that you earned. So if you had to have a uniform, then you won't be taxed on that. You had to take some of your earnings and go out and buy a uniform so you could continue. So that uniform cost is taken off your total income, and it is not taxed. Okay, so the purpose of the tax return at the end of the financial year is so that you can calculate how much tax should have been paid compared with how much tax was actually paid, as shown on the group certificate. Because usually too much has been paid, because the tax office usually assume no one has got any deductions and they charge you tax on your whole income. Yet some of it was used to earn that income and they don't know how much. So when you put in your deductions, they usually have taken too much tax. You actually paid too much. So then you would have a tax refund. If you haven't paid enough, because you've got other income coming in that wasn't taxed, maybe some other commission or something that wasn't taxed, then you might have to pay more tax. Okay, and there are 2 ways of putting in a tax return, as I mentioned before. There's a paper way, a hard copy, or the same thing is available online, and an e-form. So that's called electronic tax, and that goes to the ATO. That's on the ATO website. All right, let's do some calculations now and see what we come up with. Income, first of all. A tax return must show the total income, all sources during the year, includes wages, salaries, bonuses, tips, rent from properties owned, dividends from shares, commission. So remember, a dividend from a share is a portion of the company's company's profit, which they are prepared to share with shareholders. And for example, it's usually something like 32 cents in the dollar, or 32, but not so much in the dollar, 32 cents perhaps per share. So it's sharing the dividend is a portion of the company's profit that they're prepared to share with shareholders. Even unemployment benefits have to be counted. If part of the year you're on unemployment, you had to put that in. Austerity payments, interest from bank accounts, but only half if it's a joint account, if you've got it in company with somebody else. Okay, it should also include any allowances received from employers, meal allowance, travel allowance, living away from home allowance. Because if they send you into the country or something to repair something, let's say, then they might give you money, extra money. That's got to be put in there too. And this is called the assessable income, the total income received. Okay, let's have a look at that aspect now and look at then deductions from income. So the Australian Taxation Office, which is ATO, abbreviated, allows wage and salary earners to deduct certain payments that they've made from their income. These are called allowable deductions, and it reduces your income for tax purposes. If you can bring your total income effectively down with deductions, you'll be charged less tax. That's what we want. That's what we want. So for these payments to be allowed as deductions, they must be directly related to the earning of the income. Okay, you might have to wear a uniform. You might have to keep it clean, dry cleaning. You might have to purchase tools, safety equipment such as boots, use of your own car in doing the business, self-education. You get into a course because the course is needed in your employment. Only if the course is needed in your employment can you claim it as a deduction. Then other expenses are union fees, tax agent fees. If you feel all of this is too hard for you to work out, then you get a tax agent or an accountant to work it out, and you can claim their fee as a deduction. Donations to charities. That's to help charities, but you must make a donation over $2. Also allowed. Okay, they vary from one profession to another. A teacher might claim depreciation or something on a computer. A plumber might claim depreciation on some machine that he's working with. Okay, they all differ, and different equipment needed in that particular business. Okay, and the different professions, you can look them up on that website. Okay, so let's try to start putting all this together. Here it is now. The taxable income is the result, or the net income, after you've taken off the deductions. So your total income is called your assessable income. Then you take off your deductions, and that's what you want to pay tax on. That's your taxable income. You want this to be reduced as much as possible, and you're going to see why in a minute as we look at the tax tables and see how much tax we have to pay. Okay, so let's look at this one. Alex earns $35,400 in wages, receives $1,200 in interest from a joint bank account, so only half of that will be hers. $480 in unfranked dividends, we'll look at that in a minute. That's for the shares she's got. $250 uniform allowance, and gets a $550 Christmas bonus. So let's come down here a little bit and put it down. So there, the assessable income, let's make that heading. So do that in your work. Wages, this is all the incoming money, the income. Interest, half the interest because it was a shared account. Unfranked dividends, the whole amount have to be put in. Unfranked means no tax has been paid. Sometimes, if you've got shares, the company will pay the tax on it before you receive it, so you would not have to pay tax on that. Uniform allowance was given to her and a bonus. So all the money coming in, her assessable income was $37,280. Okay, then we put less. The allowable deduction, setting it out like this helps you organise it. Let's go through and look at the deductions. $12 a week. Look out for that. How many working weeks? 48 out of 52 and 4 weeks annual leave. So 48 times 12 goes in as a deduction. Then we've got union fees, donating $80 to charity, car expenses of $620, and she pays someone to do a return. One day that might be you. Okay, doing her return. So there are the total deductions. So we're going to tell the tax department, oh no, I don't want to be taxed on all of that. I have these deductions which have helped me make my income. I'm allowed to take them off. So it's the assessable income minus the allowable deductions, giving a total taxable income. All right, so that's the sort of calculation we're going to do for a start. First of all, down here, because it was a joint bank account with someone else, she only needed to claim half of the interest, or tell the tax people to declare to the tax department that she did receive that money, but it's only half of that. The other half is declared on your spouse's tax. Might not be your spouse. It might be somebody you're in business with, in partnership with, or something, some other sort of partnership. Unfranked dividends means you've got to pay tax on it because no income tax has been paid. It is possible, as I said before, that the company will give you a franked dividend, which means they have already paid the required amount of tax on that before giving it to you. All right, are you ready? Hope so. Let's go through it in these problems here. Just keep in mind the setting out. You toggle back and have a look at the setting out. Organisation is important in this sort of work. So the setting out is crucial. Okay, get that right and go through and get the income and then do the deductions. Okay. I think we've got all of these are already set up per annum. I think all of these amounts are PA per annum, so you don't have to multiply by any weeks or so on. Okay, have a go. Pause presentation, then fast forward. I'll show you the answers down here. There are the answers you should have gotten. Now you need to get it perfect, so if you didn't, go back, check all your numbers, check your setting out, and away you go. Let's move on and try to get towards completing a tax return. Okay, the next thing is once you've got your taxable income, then you can work out the tax to be paid, calculation of tax payable on taxable income. And it's done according to the tax rate published by the Australian Taxation Office. And it's a progressive system. In other words, as you earn more, you contribute more to run the country. This seems to be the fairest way. In other words, those who can afford to pay, pay more. Okay. So the first bracket, so these are what's called tax brackets. Tax brackets. What bracket are you in? What amount will you be paying because you're in that particular group? So 1 to 6,000, there is no tax. If you're in the next bracket, you're going to pay 15 cents for each dollar over 6,000. So you'll take your, let's put down, I will put down some steps in a minute. So you want to find how far over 6,000 you are. First 6,000, no tax, then 15 cents in the dollar. Then if you're in this bracket, let's say it's at 40,000, as your taxable income, you'd be in that bracket. You have to pay this amount first. That's the tax on the first, the starting 30,000 in the bracket. That's the tax on that. and then you have to pay an extra 30 cents for each dollar over 30,000. So again, you'll want to take away 30,000 from, you say, 40,000, work out how many thousands have to be taxed at 30 cents, and then you've got this base level tax for that bracket. Okay, this is an old one from Hayes and Harris. I forgot to mention that Hayes and Harris are providing the screen clippings here. It's handy to have a look at their book. This is the 2013-2014 financial year, and you can see you're now allowed to earn up to $18,200 because the cost of living has gone up quite a bit. And so that's not taxable, and the brackets have changed a bit. Just noticing in this top bracket back then and over here, once you're over 150 here or 180,000 as it is in these days, you're paying almost half of your income over 180,000 in tax, 45 cents out of every dollar. Okay. So that's saying if you get this large amount of money per year, you can afford to contribute to the running of the country more. You may or may not agree with that policy, but that's a progressive tax system that Australia uses for income tax. Okay, do you want to do some calculations now? Let's have a look at an example. Again, what I want you to do is to watch the setting out. In this work, the setting out and tracking through the numbers is the most important part. The maths is not that hard. Okay, calculate the tax payable. Let's do some examples. 5,300. You go to the table and you find the bracket. Here it is here, 1 to 6,000. I'm using this old tax table because we can then check our answers with Hayes and Harris there. 1 to 6,000. Okay, so there's nil tax. Okay, so no tax is payable. All right, let's go to the next one, 17,500. Let's scrub that out. First step, find the bracket. It's in there. 17,500 is in there. Now, the book has done it this way. I'd like you to do it slightly differently. You'd say, well, I've got 6,000 to 30,000. It's 15 cents for every dollar over 6,000. So let's work it out. 17,500 take 6,000, and that is 11,500. That's how they got this figure here. All right, so for the tax on the first 6,000 is nothing. The tax on 11,500 you multiply by 15 cents, which is $0.15. Keep it in dollars. So you get that amount, the total tax is that. Can you see a system that we're using? Let's put it down in words. Step 1 is find the bracket that you're in. Find the bracket. Okay, so you can write this down in your own notes. Part 2 is subtract the lower value of the bracket from your amount. See how far into the bracket you have gone. Okay, and then multiply by the rate for that bracket, for that additional money. Multiply by the rate. For example, 0.30 for 30 cents. Well, that's $0.30, isn't it? Multiply by the rate. Okay. Now I've messed that up already, I think, because, we can do it here. Now we need to state the tax, and there's two parts. Part A on the lower amount, so that is the first value in the table, so that's these values here, and then the extra tax from that bracket, and then add them. Okay, So those sorts of steps. Okay, so we need to, let's go through it for the next one. Next one is 39,400. So what bracket's it in? There it is, it's in that bracket up there. So what will we do? 39,400, subtract the lower value of the bracket, that's 30,000, 9,400 into the bracket, and for that $9,400 we have to be charged 30 cents for each dollar, so it's multiplied by 30. Okay, and then let's put it over here. We now have to state the tax on the lower amount, the first value, so here 3,600. Put that down, plus the 30 cents in the dollar gives us a total tax. Okay, get the idea of that. Just remembering that this is the first value mentioned here is the tax up to the 30,000. Let's do it again and try the next one. 87,800. First step, find the bracket. Here it is. $87,800. How far into the bracket? Subtract the first value, 75,000, not the one, because that dollar is into the next bracket. Okay, so take it away, 800. 5 from 7 is 2, 7 from 8 is 1, $12,800 into the bracket. Let's work out the tax on that, 12,800 by, here it is here, 40 cents. We'll get rid of this one here, not in that bracket now. 40 cents for each dollar over 75,000. Okay, so it's multiplied by 40 cents. Then we want to state the tax here again. So come over here. We've got the tax on 75,000 is that. That's the first value there. When you come into this bracket, you have to pay tax on 75,000 and then 40 cents for each dollar over it. So the tax on 75,000 is this one. And then we put in our 12,800, lots of 40 cents, and then get a total tax. Do you get the idea? Let's do the last one. 173,250. Let's find the bracket. So it's in here. Oops. It's in this one. Okay, so the first step is how far into the bracket are we? 173,250. Take 150,000. So we are $23,250 into the bracket. Okay, so it's 2,250, lots of 45 cents, multiplied by 0.45. Now let's put all the taxes down. Okay, first of all, tax on 150,000, getting up to the beginning of that bracket is the tax up to there is there. Then put our lots of 45 cents down, add them up. Okay, right, so you can see you've got to be systematic. And these tax rates will vary, as I showed you before. The rates now for 2013, 2014 are quite different. And you can always get the tax table from that government website. All right, are you ready? Let's have a go. And here, calculate the tax payable on the following taxable incomes. For your convenience, I have included the tax table at the bottom of this window so that you can just go straight to it and set it out. Remember, the key thing here is setting out so that you can organise your work and you don't mess up any numbers. So you need a setting out to reflect a good system. You need a system of going about this. You might make notes on that. What is the system I'm going to use? Okay, have a go at those four. I'll show you the answers now and see what you think. Here they are. Now, if you did not get that, then I want you to go back over it. You might have to discuss question 4 with a teacher or with other students and see what you think. Let's go on. We've got more to do, and that is about other things now. After you calculate the taxable income and the tax on it, you actually have to put an additional tax on for Medicare. Now, Medicare is our community health service which allows you to get subsidised trips to the doctor and medical help without paying the full bill. So how does that happen? Well, that happens because every taxpayer pays an additional tax. So it provides assistance, Medicare provides assistance in paying for basic medical care. Okay, the amount paid into Medicare funds depends on the taxable income. And the table down here shows you how to calculate the Medicare levy. And this is a later one, 2013, 2014. It's done differently. It shows the weekly earnings, and if you've got just a spouse, or if you've got one child, two children, etc. So it changes a bit depending on your circumstances. Okay, so the Medicare levy is taken out of their pay as part of their tax. So pay-as-you-go employees are paying Medicare levy throughout the year from their weekly, fortnightly or monthly pay. Okay, so if you are getting up to here on this table, 16,740, you pay no Medicare levy. From this amount to this amount, 10 cents for each dollar, so that's 10%. 10 cents for each dollar above 16,740. If you're over 19,695, it's just a straight 1.5% of the taxable income, 1.5 divided by 100, which means you would be multiplying by 0.015 of your taxable income. So this has to be added to your tax that you just calculated. You must also pay this. So overall, you need to add the two up. Now there are some other things though. There are many rules that apply to the Medicare levy, many rules, with regards to reduction or exemption and other factors. So, if you have a taxable income over 50,000, or you're a family with a combined income over 100,000 who do not have private hospital cover, there's an additional 1% of taxable income has to be paid as a Medicare levy surcharge. Why? Why is that? Well, because the expectation is if you have sufficient money, if you have more money, let's say, but who knows what sufficient is. If you have more money, you should get some additional private health cover and not just rely on the government's cover, okay, which is really there to protect people who can't afford private health. So here, this is it. If you don't have private hospital cover and you're in certain tax brackets, either as an individual or family, you will be charged another 1%. So it's trying to say, look, we want you to get private health cover so that you can help the system if you can afford it. Okay. And these cut-off values now are 50,000 for an individual, a single person, and 100,000 for a family would now be different, of course. They would be upgraded almost yearly now. Okay, let's go down and look at that. This is complicated, isn't it? All these things to do with taxation. You've got to get them right. Calculate the Medicare levy payable. There's a man who has a taxable income of 41,600. Now, she will pay the basic 1.5% Medicare levy, which is that. Now, she is under 50,000. It's less than $50,000. Okay, so she doesn't have to necessarily go and get private health cover, and she won't be charged for it. But the next person, he's 58,700 and is single with no private hospital cover. She didn't need it because she didn't go over the 50,000. But now, Mark pays a basic 1.5% levy plus a 1% surcharge. So he's got to pay overall in percentages 2.5%, which is you multiply by 2.5 and divide by 100. That's equal to 0.025. Wow. Okay, it might pay him to actually join a private hospital fund. Okay, so that he doesn't get this surcharge. Why is he getting that extra? Well, it's deemed because he got over 50,000, the cut-off. So this is called a means test. where it's testing what you have to pay according to your means or your ability to pay. Because he got over 50,000, then it's deemed that he could help support the system by having private health. So he was charged for not having private health. All right, have you got it? It's a lot of different stuff here. Now, the final thing after all this are the rebates. Okay, rebates. After you've calculated the tax due on your income, on your taxable income, and added Medicare, I'm going to put all this as a list later on, you now can take money off. You can have a rebate. And then we're going to subtract any rebates due. These are the different types to support people. So if you have somebody who's your partner, a dependent spouse, or partner, husband, wife, de facto, whom they support, so you're actually supporting that person, you can claim a rebate of up to $2,100. Okay, because you're helping that person live. And they're not getting any government help through pensions or anything like that because they're living with you. You're supporting them. Okay, but your rebate is reduced if the spouse claims more than $282 or earns more than $282 a year. So for every $4, I don't know why it's $4, earned in excess of that, the rebate is reduced by $1. Okay, so you still get a rebate until too much money is earned by your partner. Okay, so let's see if we can apply that. Remember, at the end, we're going to have to do all of these for somebody who qualifies for all of these things. So Sharon works full-time and supports her husband, who is studying at college. Calculate Sharon's rebate. Chuck earned $1,800 last year doing odd jobs. So Sharon's entitled to the rebate because she's got somebody dependent upon her. This amount is reduced though because her spouse exceeds the allowable limit. So the spouse income is $1,800. He's only allowed to have $282. So take that off. He's got $1,518 too much. So if you divide by 4, okay, you've got $379.50 or $380, round it to the nearest dollar for this part of the tax return. No cents here, just dollars. So $380 is the amount that the rebate will be reduced. Okay, because reduced by $1 in every 4. So that's a factor of a quarter, isn't it? 1 in $4, so that equals a quarter, 0.25. Or just divide by 4. Don't divide by 4. So for every $1, that's a quarter of the extra he earns. That will be the loss in the rebate. So you take that off. So therefore, Sharon, from her final tax due plus a Medicare, will now be able to take off $1,720 to allow for trying to support her husband. All right, it's complicated, isn't it? Lots of little things. You don't want to miss out on any. Oh, here's more. Here's more. If you've got a family with dependent children under 21, or dependent full-time students under 25, okay, you can claim the family tax benefit A, and this is the table. If for every child under 18, you can claim per year $1,890.70. So this comes off your final tax bill. I'll put the steps in later on. So the benefits are higher for children aged 15 and under, as they're unable to claim benefits themselves. Okay, we're only doing this simplified structure because the other one is too complex for this course. Okay, so children 15 and under, you can also get a rebate for. Too hard for you to work out is what Hayes and Harris are saying here. Okay, the benefits are reduced if the family earns more than their income limit, which is $91,542 per year plus $36.50 for every child after the first. Okay, so for every $1 earned in excess of this income limit, the benefits are reduced by 30 cents. Complicated. So we're going to have to look at situations where people have different numbers of children and see what is the overall rebate that they can take off their tax bill. A rebate comes off at the end. Okay, complicated. Let's go to the next one. Another family tax benefit. Help you if you've got a family. Okay, this is an additional benefit to single parents or single income families with dependent children aged 18 and under. So you can get both benefits, benefit A and benefit B. Okay, so here, what do we got? The benefit received depends on the age of the youngest child. Okay, so the age of the youngest child, under 5, you get that benefit. 5 to 18, you get that annual benefit. The benefit is reduced if you've got a secondary earner, somebody else earning, and more than 4,380. So for each dollar over 4,380, you lose 20 cents. And the benefits cuts out completely once you reach the following level. So the age of it depends not on the number of children, but the age of the youngest child. And we cannot earn more than these two amounts here. Okay, depending on the age of a child. So if the child is younger, then you're allowed to earn more additional income from that secondary earner before this benefit cuts out. The income of the primary earner does not affect this benefit. This is benefit B. Oh boy, isn't it getting complicated? If you're going to get your tax right and reduce it by as much as you legally can, what's allowable? You have to think of all these benefits. There's more yet. Let's go on. Let's do some with that one first. So Kevin works full-time and earns $50,000 a year, while his wife Denise works part-time, earns $10,000. Their son is 20 and Tim live with them. Calculate the family tax benefits they're entitled to for Part A. Okay, so I put the tables here for your convenience. They have a child under 18 and a child aged 18 to 24. So, under Part A, that's this one. Under 18, they're allowed this much. Put it down. 18 to 24, they're allowed that much. So that's under the tax table for family tax benefit A. Look at their combined income is $60,000, which is less than the limit of 91 plus the number of children under 18. So that. Their benefit is not reduced, so they get that full amount. Boy, you have to keep your wits about you here. Lots to worry about. You do the calculation on the children, then you've got to check, this is called a means test. You get the rebate for, or the family tax benefit, depending upon your means, your ability to pay. And they came in under the limit, and so they were not reduced. Okay, for Part B, the youngest child is 5 to 18, he's 16. So we're in this benefit scheme here now, benefit A and benefit B. So, what have we got here? The maximum benefit you can get here, because he's in this group, the youngest child, is that. Okay. But the secondary earner earns more than $43.80. And this is the rule down here. She can earn up to this. But after $43.80, so let's take that away, she earns $10,000, that's $43.80. Excess income is that. So she's going to lose 20 cents, so multiply by 0.2. Going to lose $11.24 from that benefit. So the benefit was that. Take off her reduction is that. So what are they going to get overall? Well, they've got benefit A, we just calculated up in Part A, and benefit B down there. So that's their total benefit. Oh boy, a lot of work. Setting out is important. I'm pushing this, setting out, so that you actually can work with all the possibilities here. The reductions or the reduced reductions there if she earns too much and so on. All right, you might have looked back at that one. Private health insurance, another rebate, another allowance you can get, taking off the total tax. So the private health insurance rebate is a percentage of the premium paid to the registered health fund. It is available to all Australians regardless of income levels. For most people, the rebate is 30% of the premium paid. And for most people here, it is a reduction in premiums as you pay along every month to the fund. That's already taken off for you. Sometimes it might come from Medicare or a rebate through the tax return, but generally you get that rebate in your health fund. Okay, let's have a look at the age limits here. If you're under 65, you get 30%. 65, 69, 35%, 70 or over, 40%. What's this saying here? It's saying as you get older, you're more likely to get sick. Please get private health and we will help you. We will give you a rebate, help you pay that monthly amount to cover private health, 40%. 70 years or over, half of it is paid by the government to help you, so you're not costing Medicare as much money. So you've got to think about that one. Okay, what's the next one? Low income rebate. Taxpayer with a taxable income of $30,000 or less is entitled to a maximum rebate of $750. So you work out your tax, work out your deductions, from your assessable income, work out your taxable income, work out your tax, and now you can take $750 off if you've got taxable income of $30,000 or less. However, that reduces if you're over $30,000 by 4 cents in the dollar and cuts out completely at $48,750. Little cartoon here from Hayes and Harris. He's hanging from a tree. I don't pay taxes, I don't pay rates, union fees, Medicare. I don't get down here from here for 10 years. That's the only way you're going to avoid taxes, hanging about up there. I think that's a joke, not sure about that one. All right, okay, so let's do one of those then. Regan has a taxable income of $32,100. What low income rebate is she entitled to? Well, taxable income is a little bit over $30,000. It's $2,100. So multiply by that by 4 cents, $84 is the rebate reduction. Remember, if a 4 cents reduction for each dollar over $30,000. So she could have got $750 because she went over the threshold there. It's a means test, testing her income or her means to see if she warrants the full amount. Take off 84 is $666. So she can take that off the tax that she has previously calculated, as we've been talking about. Well, that's the end. We're going to try and put all those together in these problems. And I've tried to make it easy here with the tax tables, Medicare levy, benefit A here, well that's benefit A, isn't it, I think, benefit B, and don't forget the cut-offs there, and then this is the rebate for Medicare. Okay, I think, is there another one? Age one, no, haven't got the age one there. You might have to toggle back and look at those tables. All right, so let's have a look. Here's question 1 through 4. Just check the tables there as you go through. And 5 and 6, and the answers are coming up in a minute. Okay, all right, let's go down and have a look at the answers. All right, there they are. Hope you have been able to get those down to the nearest cent there. The final amount is taken to the nearest cent. Entries in taxation returns or on the e-tax are usually only in whole dollars, but the tax payable or whatever is taken to the cents at the end. All right. Well, the next presentation is exciting. We're going to put it all together and do an income tax return. But cheers for now.